Leverage, in the world of crypto trading, is like borrowing money to supersize your bets. It allows traders to control a larger position than what their actual capital would permit. Imagine you want to buy Bitcoin, but you only have $1,000. This amount might seem small in the grand scheme of things, especially when Bitcoin prices can be quite high. With leverage, you can enter a trade worth much more, say $10,000. This means you can potentially make bigger profits than you would with just your initial capital. This is your ticket to potentially multiplying your profits. The excitement of seeing your gains grow exponentially can be thrilling. But remember, leverage is a double-edged sword. While it can amplify gains, it can also magnify your losses. The same leverage that can make you rich can also lead to significant losses. While it can amplify gains, it can also magnify your losses. A small adverse movement in the market can wipe out your entire investment. So how does leverage actually work? Understanding the mechanics behind it is crucial for any trader. Let's say you're using 10 times leverage. This means that for every $1 you put up, your exchange will lend you $9. This significantly increases your buying power. This means for every $1 you put up, your exchange will lend you $9. You're essentially controlling a $10,000 position with just $1,000 of your own capital. You're essentially controlling a $10,000 position with just $1,000 of your own capital. This can be a powerful tool if used correctly. Now, if Bitcoin goes up 10%, your $10,000 position becomes $11,000. This is where the magic of leverage comes into play. After returning the $9,000 loan, you're left with $2,000, double your initial investment. This is a significant return on investment, showcasing the power of leverage. However, the opposite is also true. The market doesn't always move in your favor, and this is where the risk of leverage becomes apparent. If Bitcoin drops 10%, your $10,000 position shrinks to $9,000. This can be a devastating blow to your investment. Since you borrowed $9,000, you lose your entire $1,000 investment. This is the harsh reality of leverage trading. This is why understanding leverage is crucial before diving into the world of leveraged crypto trading. Educate yourself, understand the risks, and trade responsibly. Leverage can be a powerful tool, but it requires careful handling and a solid understanding of market dynamics. Margin trading is the mechanism that powers leverage. It's like taking out a loan from your exchange to amplify your trading position. The money you deposit with the exchange to open a leveraged trade is called your margin. This margin acts as collateral for the loan you're receiving. Think of it like this: you're putting down a security deposit on a car rental. The car rental company allows you to use their car, but they hold on to your deposit as collateral. In margin trading, your margin is the deposit, and the amplified trading position is the car. The amount of leverage you can use depends on the exchange and the specific trading pair. Some exchanges offer leverage as high as 100 times or even more. But remember, higher leverage means higher risk. If the market moves against you, even slightly, you could face substantial losses. The primary reason traders are drawn to leverage is the potential for amplified profits. Leverage allows traders to control a larger position with a relatively small amount of capital, making it an attractive tool for those looking to maximize their returns. With leverage, even small price movements can translate into significant gains. This means that a minor uptick in the market can result in a substantial profit, which is particularly appealing for traders who are looking to make quick gains. This is particularly attractive in the volatile world of cryptocurrencies where double-digit price swings are not uncommon. The high volatility of the crypto market means that prices can change rapidly, providing numerous opportunities for leveraged trades. Imagine Bitcoin is trading at $20,000. You see an opportunity and decide to take advantage of it. You believe the price will go up and decide to use 10 times leverage with $1,000. This means you are borrowing additional funds to increase your trading position. You're now effectively controlling $10,000 worth of Bitcoin. This magnifies your potential gains, but also your potential losses. If your prediction is correct and Bitcoin climbs to $22,000, a 10% increase, your $10,000 position becomes $11,000. This 10% gain on the larger position results in a significant profit. After repaying the $9,000 loan, you've doubled your initial investment to $2,000. This demonstrates the power of leverage in amplifying returns. This ability to generate outsized returns is what makes leverage so enticing, especially for traders with limited capital. It provides an opportunity to achieve significant profits without needing a large initial investment. However, it's crucial to remember that leverage is not a get-rich-quick scheme. While it can amplify gains, it can also amplify losses. Traders must be aware of the risks involved and use leverage responsibly. It's a tool that, if not used responsibly, can lead to devastating losses. Just as leverage can magnify profits, it can also magnify losses, potentially wiping out your entire investment. Therefore, it's essential to have a solid risk management strategy in place when using leverage. Educating yourself about leverage and understanding the risks involved is crucial. Many successful traders spend a significant amount of time learning about leverage and developing strategies to manage the associated risks. Tools such as stop-loss orders can help manage risk by automatically closing a position if the market moves against you. This can help limit potential losses and protect your investment. Having a well-thought-out trading plan and sticking to it is also essential. This includes setting clear goals, understanding your risk tolerance, and being disciplined in your trading approach. Reflecting on your trading performance and learning from your experiences can help you improve over time. By continuously educating yourself and refining your strategies, you can become a more successful and responsible trader. In conclusion, while leverage offers the potential for significant profits, it also comes with substantial risks. By understanding these risks and using leverage responsibly, traders can harness its power to enhance their trading performance. Section 4. The downside, magnified losses, and liquidation. While leverage can amplify gains, it's equally capable of magnifying losses. This dual-edged sword can be both a blessing and a curse for traders. Just as a small price movement in your favor can lead to significant profits, a small move against you can wipe out your entire investment. The volatility of the market can turn a seemingly promising position into a financial disaster in a matter of moments. This is where the concept of liquidation comes into play. Liquidation is a safety mechanism employed by exchanges to protect themselves and traders from excessive losses. Liquidation occurs when your losses are so substantial that you can no longer cover the loan you took from the exchange. Essentially, the exchange steps in to close your position to prevent further losses. Remember the margin you put up as collateral? This margin acts as a security deposit to cover potential losses. When the value of your position drops below a certain level, determined by the exchange and your leverage, your position is automatically liquidated. This threshold is known as the maintenance margin. Let's say you're using 10 times leverage on a $1,000 Bitcoin position, effectively controlling $10,000. This means any price movement is magnified tenfold. If the price of Bitcoin drops even by 10%, your $10,000 position becomes $9,000. This seemingly small drop has a massive impact due to the leverage. Since you borrowed $9,000, you've lost your entire $1,000 investment. The leverage that once promised high returns now results in significant losses. The exchange automatically closes your position to prevent further losses. This automatic closure is known as a margin call, and it can happen very quickly in volatile markets. This risk of liquidation is inherent to leverage trading. The higher the leverage, the greater the risk of liquidation. It's crucial to understand that even experienced traders can face liquidation if the market moves against them unexpectedly. No one is immune to the rapid changes and unpredictability of the market. This is why responsible leverage usage and robust risk management are paramount. Traders must set stop-loss orders, diversify their portfolios, and avoid over-leveraging to mitigate risks. Stop-loss orders are preset levels at which a position is automatically sold to prevent further losses. They act as a safety net, ensuring that losses are contained. Diversification involves spreading investments across different asset classes to reduce risk. By not putting all your eggs in one basket, you can protect yourself from significant losses in any single investment. Avoiding over-leveraging means using leverage levels that are manageable and align with your risk tolerance. It's better to use lower leverage and stay in the game than to risk everything on high leverage. In conclusion, while leverage can be a powerful tool for amplifying gains, it comes with significant risks. Understanding these risks and implementing strong risk management strategies is essential for any trader looking to succeed in the volatile world of leverage trading. Section 5. Navigating the leverage landscape. Tips for beginners. Navigating the world of leveraged trading can seem daunting, especially for newcomers. However, by following some key principles and approaching leverage with caution, you can mitigate risks and potentially enhance your trading outcomes. Here are some essential tips for beginners. Start small. Don't jump into the deep end with high leverage. Begin with the lowest leverage offered by your exchange and gradually increase as you gain experience and confidence. This allows you to understand how leverage works in practice and how your trades react to market fluctuations.